the history a little bit is actually very, very interesting and very exciting. Let's plunge into that. Yesterday, I think there was a request to stop no later than 4:25 because of Delhi traffic. So we'll try and do that. The second thing, a very, very good suggestion was made, and this I'm addressing to my team members. Your name, sir?
Yeah, Deepak.
Deepak here raised a very good point. He said, could we make available the data that goes into many of these slides? We can't do it for all the slides because some we've taken from elsewhere, but wherever we have constructed these charts ourselves, I think we should try and make available these charts. Yeah, we should try and do that. Is that useful for all of you?
Yeah.
Okay, good.
Online. Please cite the source.
No, we have we've actually, wherever possible, we've given sources, but I mean, to make life a little bit easier for you, we actually have produced a lot of this using Excel. We'll try and make available the Excel data because then you can give that as exercises for your students. I think that will be useful. Yeah. Okay. So recommended readings is that you're being too lazy here. No, if you've given recommended reading, you just have to Google it and find the link. So request.
Many of them may not be available.
Whatever. We've tried to do whatever we can. Okay. So let's. But we will do that. So already we have readings. Most of them I've accessed actually without. So your request is dismissed, sir. Okay. Yeah, one more.
Sir, there are few figures in the latest economic survey, and the sources are not given. So it would be like the easy.
Okay, sources. No. Okay, we'll try and whatever we can, we'll try and make available. Yeah, all the stuff. And if you have particular requests, you just write to us, and we'll try and meet them. Yeah. That was the one. Okay, today we're going to talk about economic crises, yeah? But I think that financial and economic crises, and we're going to call them financial-economic crises or whatever, combining the two, have happened with absolutely depressing regularity in the last 35 years. I don't want to take you through all of them, but basically since the early 1980s, and this is not even an exhaustive list, we had the Latin American debt crisis, which actually began or was a direct consequence of the two oil shocks. The oil shocks happened, the money was recycled, lent to many Latin American countries, they overborrowed, etc. Then 91, we had India's BOP crisis. 94, we had the Mexican crisis, and then the Argentinian crisis. Then, of course, 97, 98, the Asian financial crisis, Russia. Brazil, 99, Eastern Europe, 2007. Then, of course, we had the biggest bazooka of them all, the global financial crisis in 2008 with the United States at the epicenter. And then a prolonged crisis in Europe, Greece, Ireland, Spain, Iceland. And the Greece, of course, continues. 2013-14, we had the taper tantrum in which India was implicated. It's called the Fragile Five emerging market countries. And 2016, we saw the first tremors in China. June of 2016, the stock market. So these things have happened with really, it's become like, it's happening all the time and very frequently. Now, this is, a book from Reinhardt and Rogoff. This tells you what percentage of time countries are either in external default or restructuring. You can see the probabilities are quite high, often reaching 50 or whatever. This is from their famous book, This Time is Different. They have an article as well. So, if I were to ask you what is a crisis, what do we mean by a crisis? Then, just step back. I think that broadly defined, it's basically what happens is that you get a sudden disruption and a loss in the value of 2 or 3 key assets in an economy. It can vary from economy to economy, which is combined with a lot of real economic hardship, mostly in the form of declining GDP growth, but also it could be also be high inflation as a result, declining growth, unemployment, a large-scale social disruption, as happened during the Asian financial crisis. But the key things are there's a big change in some asset value and some big real economic costs. That's what a crisis, I think, if you were to try and define what a crisis is. Now, what kinds of assets, lose value? I can think of 3, maybe there are others. Certainly, in the emerging market countries, the currency loses value quite sharply and quite quickly. So it's not just a substantial loss in value of assets, it also happens quite quickly. In fact, I would say one of the most, I forgot to say this, the most insightful comment on crises was made by a professor at MIT called Rudy Dornbusch. He was a great international economist, and he said, crises take longer coming than you think and happen much faster than you would have thought. So, you say, oh my God, we're safe, nothing's going to happen. And suddenly it happens. It takes a long time. And then when it happens, boom, it happens very quickly. So currencies lose value. And that's what happened in India in 1991, Thailand during the Asian financial crisis, Indonesia during the, lots of these countries, Brazil in 99, Argentina, Mexico, 94. Equity, in Japan, for example, the stock market lost a lot of value. In Argentina as well. So the stock market could collapse. And of course, real estate prices could also come down. Again, happened in Japan, happened in the US after the crisis. So essentially what happens is that there's a run-up in asset values, suddenly loses value, creates a lot of economic disruption, and that's what it's kind of a crisis. As you can see here, the Thai baht in 97, boom, it declined in value. Argentina, the stock market declined. In Japan, there was a sharp decline in real estate prices. Prices, yeah. Now, I've said before, income, high inflation, unemployment, and of course, serious banking problems as well. And contagion. The funny thing about the Asian financial crisis was that, everyone thought, these countries are doing fine. And then when the first trouble hit Thailand, it served as a kind of wake-up call for investors, thinking that if one Asian country is bad, it must be that others are bad, and it spread like contagion to these other countries. In my example, the biggest case of a near contagion that almost happened but didn't was what happened around 2010 in Europe. The fear was that Greece, if it had had a very serious problem, maybe it could have spread to the rest of Europe in a way that could have made the whole Eurozone collapse. But it didn't happen. They took a lot of action. But one thing about these things is that it spread. Similarly, in 2013-14, it hit a bunch of emerging market countries. And the reason it happens partly is because of the way the investors think. They invest like in groups. So if they think one element of one group is a bad apple, they want to pull away from that entire group, regardless of the differences between these countries. So no amount of us saying, oh, we are not an emerging market country, we have sound fundamentals, don't treat us like country X, in these crisis situations, often doesn't carry too much weight, because investors think it's like herd behavior. Now, when you think about economic crises, this is of course one of the most famous photographs after the Asian financial crisis. Here was an independent leader of a country for 25, 30 years, Mr. Suharto. He basically owned and ruled Indonesia, but then he had to go begging to the IMF for money. And this is the image of, all of you who think in colonial imperial terms, it can fulfill your fantasy. Here's the white man, smugly presiding over a poor emerging market country. And do not underestimate the power of this photograph, because after the Asian financial crisis, after that, every Asian country said, over our dead bodies, we will go and borrow from the IMF. Even if we have a crisis, we will never go and borrow to the IMF. In fact, in the 2008 global financial crisis, people don't know this, and I'm going to come to your question about the US Fed as well later on. In the 2008 financial crisis, a number of countries, even though they were not in crisis, they wanted to take precautionary measures, they did not go to borrow from the IMF. Guess who they borrowed from? The US Federal Reserve for dollars. They didn't borrow from the IMF. So the IMF, you have to. I'm not saying you should blame the IMF. There's a kind of messenger and message kind of situation. But the point is that if you have a crisis, big things happen. And of course, in parts of Asia, a political change happened as a result of the crisis. But this is a kind of iconic picture, both of what happens when you mismanage a country and of whatever about the IMF. They say IMF stands for International Monetary Fund. I think the best description which captures this is insolvents must fawn, F-A-W-N. They must fall at the feet of the IMF. So if you're insolvent, this is what happens to you, is a reminder of this. Now, in last year's survey, which I'd like you to go and read, we actually did a detailed taxonomy to understand, because as you saw, there were so many different countries in crisis. But how can you think about them analytically and conceptually? Something that your students, I think you should really try and encourage, because you can say, it happened here, it happened here, it happened here, but what were the similarities? What were the differences? I think that's something that I really would urge you to think about, because that helps one understand all these things. So I think there are broadly 2 or 3 different categories of crisis. Okay, so there's what's called a first generation crisis, which is, back to my old, I think I will never crack this one. Friends, I'm thoroughly incompetent on this. Oh, that's brilliant. Okay, this is what are called the first generation crises, in which essentially governments borrow too much. That's what's happened, as you can see, Latin America, India in 1991, even Greece. Governments borrow and spend too much. The current account often deteriorates. You don't have enough money to repay your debt. And then usually you have fixed exchange rate regimes. There's a speculative attack. The currency collapses, and you have a lot of disruption. So that's straightforward, government borrowing that happens. In the second kind of thing, which we call a sudden stop, what happens is that it's not that the government borrows, but it's the private sector that borrows. So in this, typically what happens is a lot of foreign money comes in, domestic corporates borrow, domestic banks borrow, and then what happens, some trigger happens. In the case of Thailand, in the case of these countries, there was a feeling that the currency was becoming uncompetitive. The current account also widened in these countries, and then there is, to use the terminology of Guillermo Calvo and Carmen Reinhardt, there's a sudden stop. Money that came in goes out, the currency collapses, banking systems can collapse, firms can collapse, and then you have a major crisis. You're about to be signed out. Why is that? No. Discard. Okay.
It will be off in 10 minutes.
Huh?
It will restart in 10 minutes.
Okay, this is a crisis, exactly. This is a... exactly. Sudden stop, exactly. My friend. Professor Paul, you're fired. Where's Professor Colin Paul?
It was saying it will restart during the break. It was coming on the screen. It will restart
Okay.
so many hours.
Okay, go to your table. Go to your table. We can follow this on your table. And so that is the second kind of situation where the private sector borrows. Now, in both of these, whether the government borrows or the private sector borrows, essentially these things happen in emerging market countries. Usually there's a fixed exchange rate, and then the exchange rate collapses, and that's what triggers the crisis. Now, important thing to remember is that, and this happened in India as well, because all these companies have borrowed in dollars, when the crisis happens, in some sense the crisis makes the problem worse, aggravates the problem, because balance sheets are in dollars, currency depreciates, the value of this goes up, you have to make more repayments, and this is what's called also, the balance sheet effect in emerging market crisis, which makes things much worse. So these are two things that typically affect emerging market countries, but there are exceptions. In Greece, it was exactly like India, where the government overborrowed and got into trouble. I'm talking about Greece in 2010 onwards. Spain and Ireland, in fact, are very much like, and Iceland actually also is like a sudden stop where money came in and went out. In the case of Spain, of course, it was part of the Eurozone, so you didn't get that currency impact, but because you didn't have the currency, it actually made the problem worse in some extent because they couldn't adjust very easily. So that's one. Then we have different crises, not in emerging markets, where the exchange rate and this foreign borrowing is not so important. What happened in Japan and what happened in the United States. So in these cases, what happens is that you have a massive increase in asset values. It may or may not be due to borrowing from abroad and currencies, because remember, in both cases, in Japan and the United States, they did not have fixed exchange rates. They've allowed their currencies to move up and down all the time. But in these cases, what happened was big buildup in asset prices and in credit from the financial institutions. Then the asset price, in the case of Japan, both equity, is that sugar? Thank you. Both equity and land prices collapsed. In the case of the United States, so in the case of Japan, it was the firms that had borrowed too much. In the case of the United States, households had borrowed too much and that collapsed. And so you had, and of course, in the case of the United States, because it was the epicenter of the financial world, it was a global financial crisis. It was the first global crisis after the 1930s, when you had similar kinds of, different kinds of crises, but a crisis that affected all countries. The Asian financial crisis pretty much restricted to Asia. The Latin American crisis was restricted there, but the Japanese crisis was largely confined to Japan. But the global financial crisis spread all over the world, and so you had a completely different order of magnitude from this crisis. So are we going to? Okay, so now what I would like to do is then just go to the page. By the way, your what you actually have. Come in. What you actually have, it's like, and we're going to post the revised version up. It's slightly different because we changed the sequencing to some extent. Yeah, question. We can take good time for questions.
In case of 1991, India's crisis, was it because of government borrowing, or was it because of overvalued exchange rate to a large extent?
Yeah, see, but the question is, in the Indian case, was it a government borrowing or an exchange rate? And the answer, it was both. What happened was the government borrowed, the fiscal deficit went up, the current account deficit also went up. inflation was high, we had a fixed exchange rate, and then we couldn't generate enough money to meet our external obligations, and therefore you had. So these are all linked. The fiscal expansion, the current account deficit expands. We don't have enough money then to repay our obligations. We have a fixed exchange rate, and then the currency goes down. Yeah, the question.
Sir, in mid-1990s, there was a sluggishness in our economy, but the same because of Asian crisis and so on. Why the same was not depicted in the first module where we see the growth rate, Hindu growth rate, and the consequent years growth rate. The growth rate in mid-1990s was moving up. I thought there would be a economic cost associated with these Asian crisis and other problems which are going in the mid-1990s.
Okay, so I will actually come to that when I talk about India as well, yeah? I will come to that. And your question?
International
Yeah.
scenario.
Yeah. Mike, please.
Mike, please.
Thank you. It's been fixed. Okay, so before we ask the question, let's have a quick video on this is the US financial crisis.
Michael, how are you?
I found something really interesting.
The whole housing market is propped up on these bad loans. They will fail.
The housing market is rock solid.
It's a time bomb. So Mike Burry, who gets his hair cut supercuts and doesn't wear shoes, knows more than Alan Greenspan.
Dr. Mike Burry, yes.
So that guy there knows more than Alan Greenspan. And I'm going to come to Alan Greenspan later on. And that was the, are we going to show another one? How many of you seen The Big Short? This is this movie, The Big Short. I would encourage you, I don't know whether you like seeing movies or not, but certainly to me, the best book about the financial crisis is the book by Michael Lewis called The Big Short, because it tells you how even in an advanced economy with sophisticated financial institutions, you would think these things can't happen, how it can happen even in a country like that. And it explains that very beautifully and what is so special about that.
The highest level, AAA is getting paid first. The lowest rated B is getting paid last, taking on defaults first. Now obviously if you're buying Bs, you can make more money, but they're a little risky. Sometimes they fail. Chris? Somewhere along the line, these Bs and double Bs went from a little risky to dog shit. Where's the trash? I'm talking rock bottom FICO scores. No income verification. Adjustable rates.
So in a sense, what they should have shown is that the whole thing collapsed like a pack of cards. And so I mean, it's amazing how this can happen in. So I want to relate this to the Indian experience and kind of answering some of your questions.
International scenario.
Yes, you had a question, sorry.
Quick question. So when we had the Southeast Asian crisis in around 97, that time also saw the emergence of China as an exporter because they grabbed the opportunity. Now in China, what we see today that their corporate debt is soaring. So do you really think that it might head towards bad time for China? And is India in a position that suppose within 4 or 5 years this happens and then Make in India you have started? So do you think that we are in a position not to come as a big exporter but significant improvement in our exports?
I always call this the Jana Gana Mana moment. When you say will India gain at someone else's? This is we're going to come to that. I'll come to that in a second. Okay, this is hum honge kaamyab. We have to. But wait a second to answer that question. So India has had, currency sudden stop. 91, it was like a straightforward debt crisis, where we, overspent, overborrowed, exchange rate fixed, unable to, meet our external obligations, and we had to go to the IMF. Thank God there was no picture, like there was no photographer, there were no iPhones then, and if it had a picture like that of our Indian leader with the IMF, I think certainly that Indian leader could never have been elected in India ever again. Just as yeah. So then we had, and in a sense, it comes to the question that you asked about 1998. You see, the really interesting thing is that in 1998, every other Asian country, I mean the East Asian countries, Thailand, Korea, Indonesia suffered greatly, but we didn't. And there's a very simple reason why we didn't. I don't know whether, and we didn't borrow, this is net capital flows, we borrowed very little in 1998. So we did not have could not have had a sudden stop. So that was a very important reason why we didn't have a big crisis in 1998.
Another thing, they were heavily into exports, and because we were at
No, don't confuse the two. If you export a lot, you build up surpluses like China did, and then you're going to be very strong and invulnerable to a crisis. However, once a crisis happens, if you export a lot, the consequences will be a lot for you because you're very dependent on exports. So exporting a lot and building up a current account surpluses, building up your reserves is a good thing to immunize yourself, to insure yourself against crises. It's only when you're exposed, like it happened in the global financial crisis, those countries who exported more, especially to the United States, were affected more. But those are very different things, before and after. So 98, we pretty much avoided that. 2013 was like a sudden stop. Essentially, I'm going to show you here exactly what happened in 2013. Leading up to 2013, look at this big increase in capital flows. I should be here. This big increase in capital flows, that's what made us vulnerable then. And the only reason we didn't have a full-fledged crisis, in my view, was because the exchange rate was pretty flexible. Had we kept our exchange rate fixed and that had happened, capital would have gone out and would have had a 10, 15, 20, 25, 30% drop in the currency, and that would have been very, very disruptive. So it was almost a sudden stop. But what is interesting is that, and this is what we're going to look into in terms of the twin balance sheet problem, is that afterwards we've had this what we call the twin balance sheet problem. Now it has very little to do with exchange rates or foreign capital flows. It has to do much more with banking and corporates, like it did in Japan and the United States. And what we face now is something that we call a twin balance sheet problem. So what is a twin balance sheet problem? Essentially, the twin balance sheet problem is that both banks and corporates are stressed. So on the right-hand side, you see, this is data from Credit Suisse. How many companies have debt in which they do not generate enough earnings to be even repay your interest? So this is ICR is a measure called interest cover ratio. Does a company generate enough money just to repay interest? Forget about the loan, forget about everything else. And in the markets, you only get an investment grade rating if your interest coverage ratio is 2. So if your interest coverage ratio is not even 1, it's basically junk debt. It's a company is kind of like junk, not even investment grade. So nearly 40% of the debt today, the private debt in India, is with companies who cannot generate enough to repay their interest. So that's the first balance sheet that's challenged. Reflecting that, a mirror of that is the fact that we have banks who lend to these companies now have many of these assets are not very good. So we have non-performing assets as a share of total thing is quite high, and it's about, and it's mostly concentrated in the public sector banks. We're going to come into why that's the case, but it's mostly in the public sector banks. I want you to notice and keep in mind here two things. 97, 98, we avoided the Asian financial crisis because we didn't borrow that much. But I also want you to keep in mind here that around 2002, 2003, we had similar problems in our banking system like we do today. So for example, today NPAs are like, whatever, this is the official number. We had, big problems even then, but then we didn't have any the same problems like we do today, and I will come explain that in just a moment. So twin balance sheet, corporate, the private sector is stressed, correspondingly and reflecting that and deriving from that, banks are also, especially the public sector banks, are stressed. Okay, now what is the origin of this problem? And this is very important. The origin of the problem goes back to the 2000s. What happened was during this boom period, you see, this is the period when investment rose very sharply and private investment rose very sharply. So that is where it all begins. Remember, in the 2000s, beginning 2002, 3 onwards, India's growth rate increased rapidly. We thought, finally we were going to go, not just break from the Hindu growth rate, but the 6% growth rate to the maybe double-digit growth rate. In fact, I think one quarter we actually had double-digit, but in that period we averaged about 8.5, and this was kind of the India shining period. And in this period, private investment and total investment increased by about 10 percentage points, and private investment increased, accounted for a big share of that increase. Essentially, the private sector got into infrastructure. This private investment was in infrastructure. There was a private sector-led boom in India. That's where, remember, crises almost always begin with good news and booms. And has to come. So I don't have this in my recommended readings, but probably the classic book to understand crises and things is a book by Charlie Kindleberger. It's called Crashes, Manias, something, and it begins with what happened, in 1700, 1800. It traces through all the historical crises that happens. Essentially, it always begins with good news. And then, of course, what happened in this boom was, this is a boom that was financed by, look at this, rapid credit growth, right? And a rapid increase in foreign. I'm not going to go into it in great detail, but the interesting thing was this. The spending was all done mostly because of PPP projects by the private sector, but the money was lent by public sector banks, not by private sector banks. Most of the financing of this happened through, and that's why all of this money, all of the problems today ended up in this way. Like in many crises, what happens is that once you borrow, remember this is a depreciation of the currency, this is another depreciation of the currency. Again, all those infrastructure firms that borrowed in dollars, their borrowing increased in rupee terms. That added to the problems of the corporate sector. So this is now. So just to give you a sense of this, in February 2016, when the public sector bank financial results came in, investors fled, because they thought the public sector banking system was not very sound. And you had a situation in February 2016 where the stock market capitalization of one private sector bank, HDFC, was equal to all the other banks put together, all the other public sector banks put together, because markets thought that all these public sector banks are not worth very much. so this is the market capitalization of the public sector banks and the private banks, all same. So if you look at NPA ratios today, they are as high as they were in Korea, South Africa, Brazil. But this is the Janaganamana point, is that it is still not as bad at all as in China. Just to give you some indicators, if you look at estimated non-performing loans, India and China, see, China had a similar episode in 2002 when it had non-performing loans, 23% of total loans and 14.4% of GDP. We too had a crisis at that point in the banking system, which I'm going to come to. But today, you look at the loans as a share of GDP is lower in India than in China, and that's partly because the amount 60%, 50% of GDP is a lot. So even if things were to go really bad in, just as a hypothetical case, the point is that it will make a demand on a much bigger share of Chinese economy than it will on our economy, in the worst case scenario. So in that sense, our situation, we have to be careful, we have to monitor, but it's not as bad. So remember the chart I showed you of Spain, Thailand, etc., Ireland. In fact, this is nowhere. Just to give you an aside, in terms of probably the numbers where they looked the worst was in Iceland. In Iceland, if I'm not wrong, bank loans as a share of GDP, bank loans were 11 times GDP. 11 times GDP. And it's a crazy thing that happened. And there was another figure, but anyway, it was 11 times GDP, so it was really very bad. So in that sense, one should keep this in terms of magnitudes, the perspective on what's happening. Now, yeah. Yeah.
Loan to value ratio will make any sense here, sir?
Yeah, loan to value. Loan to value is more a measure of, it's a kind of prudential measure. That is, if you want investors or borrowers to put in more down payment to have more skin in the game, then you should, then you look at that. It's a kind of, so it's a way of actually tightening things. You don't want very reckless borrowing and lending, so you say loan to value ratios should be low. But that's a very good question, because it reminds me of something that let me finish this, I forgot to say, and then I'll take a question. So if you look at what happened in India in this period, it was like classic many countries that had this kind of problem. Overborrowing by corporates, both from the banking system and in this, and overinvestment as well. And essentially what happened was, when the boom was going on, people thought that, people made their plans for investment and borrowing as if these growth rates would stay forever and forever. That is the classic mentality of a boom. You think booms never end, booms will always, it's what Alan Greenspan used to call irrational exuberance. We had lots of irrational exuberance. And what happens, which comes to your loan to value point, which is a very good point, is that in that situation, including in India, firms and borrowers start taking more and more risks, because you see, oh my God, growth is so good, let's go for it. What happened was loan to value ratios increased, and of course the story is that firms, instead of relying at least to some extent on equity, basically most of it was just debt, leverage ratios went up, there was very little skin in the game for these promoters, and that encouraged more and more risky behavior. Remember, the more equity you have more skin in the game, you're going to be more prudential. But if you're just borrowing someone else's money to invest, it's heads you win, tail, someone else loses, and so that's the kind of thing that happened in India. So I think what also happened was there was a lot of reckless behavior, and of course something that I don't want to get into too much, which we see more now exposed, there was also a lot of cronyism, lending to people for political reasons and so on, which aggravated the problem, and that's why. So the lesson here is that in terms of the build-up to the twin balance sheet challenge, India was not very different from many other emerging market countries. What has turned out to be different is the aftermath, is that we haven't had as bad the aftermath to this as many other countries that I showed you just now. Yeah. You had a question? Someone? I have one more question. Well, no, let's you had a question, sorry. Mike, please.
Basic question. So given this current scenario of China, what is it doing to correct this situation right now?
Can I take China-related questions at the end? I'll tell you what China is doing. I can tell you what. See, I'm just trying to see how to sequence this. Now, okay. Let me do something to clarify matters here. So I said that. Oh my God, where is the chart on the, oh, this is the chart, right? So, where are the NPA charts? Is it before or after? Oh yeah, this one, right? So, we had a similar bad situation with the public sector banks and the banking systems, in fact, even worse at that point in time. But what happened in India was essentially, after that point in time, the banking situation was pretty bad. NPAs were pretty high. But after that, growth took off. And so many of the things that were looking bad, this was the period, late 90s, early 2000s, growth was still very weak. But then as the problem seemed to be peaking, growth took off to 8%. Many of these problems got solved almost automatically, because remember, if growth happens, many of these assets start looking good, you make more money, you're able to repay, and things sort of improve themselves. Now, the reason I mention this is to answer, there's a China 1 and a China 2. China 1, around this time, late 90s, early 2000s, it had a similar situation. What then it did was, it basically created what we call 4 bad banks. There were 4 big public sector companies. They created bad banks which took the bad loans from outside the banking system. They kind of tried to clean it up, and then the banks were allowed to start functioning again. Now that's China 1. We'll come to China 2 a little bit later. Yeah. Yeah. Query. Yeah.
Yeah. So the investments in infrastructure projects during the boom period were mostly based on PPP sort of.
Yeah, PPP. They were almost all PPP projects. Yeah, I mean that was the predominant. You see, remember at that point, the decision was made, rightly or wrongly, I don't know, that people felt that both the public sector finances were not very strong, and therefore we needed the private sector to do it. And then there was also the sense that the private sector would be more efficient, et cetera, et cetera. So a combination of both a kind of ideology and the fact people felt that the public sector didn't have the resources, and a combination of that led to PPP. Yeah.
In case of China, the percentage of total loans, the bad loans are 15.5%. And while the bank credit to GDP ratio is 137, so how can it be 12%? I mean, 15.5 is out of 100. So out of 137, it should be higher than 15% here.
Yeah, so the question is, as a percentage of total loans is 15%.
And since loans are 137%, so it should be 1.37 times of 15%, as I understand.
This table, no?
Yeah, so 15% of 137. Let's check that. Yeah, it could be higher as well. Yeah, so a good point. Let's again check that number. Good point. We should. So maybe the problem is even worse than we're showing you. Yeah, maybe around 20% as well. Exactly. It's a good point. Very good point. Yeah, one question there. Yeah, you haven't asked the question. Sorry. Yeah.
Just one clarification
Yeah, please, into the mic, please.
So just one clarification question, that when we are saying that the share of NPAs is generally higher in India for the public sector bank than the private sector bank, is it just a simple case of public sector always like bailing out, trying to bail out the private sector?
That's a good question. I mean, so what could happen is that you have an initial decision to lend to the private sector. But afterwards, when things start going bad, how do the banks respond? Is it, do they respond very differently from how private sector banks would have? And if you give me 2 minutes, I'm going to come to exactly that. But I just want to make clear that it's not that in India that all the problems are in the public sector banks. There are some private sector banks also that have bad loans. But so the first response to your question is that between public and private, you can say, in the first instance, how do they make decisions to lend in the first place? Is there a difference? Could there be more cronyism here or there? The second question in terms of how they respond, could there be differences as well? And I'll tell you how the public sector banks responded. If you absolutely must ask a question, please ask a question. Oh no, sorry, he has the phone. Here, given the mic, if you have the microphone, ask it, please.
Sir, what about the composition of loan? Actually, I am analyzing the agriculture loan from 1992 to 2015. Basically, it's a composition of the loan, particularly the agriculture sector. The share of LBA, larger borrower account, was much higher than the share of SBA. So, in the earlier crisis-like situation, it was more spread, because more people were benefited. Now it's concentration of the loan is very high, even in the hands of large borrowers, particularly in the agriculture sector. And the situation is worse if the non-agriculture sector.
See, I think, let me just say that, and I was going to come to that in a second, but essentially that in this episode, I don't know about agriculture certainly, but certainly in the non-agricultural sector as well, the loans are highly concentrated. If the number that I told you, that stressed loans are 40% companies, most of that is actually, a lot of the stress test is with about 25, 30, 35 companies. It's very concentrated. One last question before we move on, yeah.
So that's same total bank credit versus GDP when we compare India and China. See, a good quantum of loan from in India is not necessarily from banking sectors, it is from non-banking sectors and from unorganized sectors. So, because it has been completely rural and microfinancing, if you look, before 2014, it has been 72 to 78% of funding in the rural areas has been from unorganized sector. So, when you are not considering that, so to what extent this data is a real comparative data at comparison with international forum as well as with bilaterally to any country?
Yeah. So again, that's a good question, because essentially the data that we have is credit extended by banks and financial institutions that are regulated by the RBI. We have data on that. We don't have data on the other stuff. Now, because then I also don't know what the Chinese data is. China, there could also be non-bank sources of funding. So in the comparison, I don't know which is more, which is less. But certainly, if India is disproportionately more in this, the comparison would be not exactly accurate in that sense.
That cannot be called NPA, but unorganization sector is not giving money to anybody. They take a lot of guarantee. It's not NPA.
Well, we don't know, right? I mean, we don't know, after all, even these loans are against, there has to be some collateral. And the quality of collateral can vary. We don't know exactly what it is. Question, not a statement. A question, yeah.
In a country like China, where there is a distinction between debt, ownership of assets, and the companies which are doing the work, that distinction of debt is very misnomer, because the assets are owned by the companies are themselves doing it, and the debt is also from banks are also owned by the government.
Yeah, structure can change, but I mean, in India also, let me just move on, because India too, the banks are owned by the government. So now, but the key thing I want you to take away from this is that the run up to the crisis is not very different in India, or not to the twin balance sheet challenge elsewhere. What is very different about India is the consequence, what happened, after the crisis. I am tempted today not to take a break in between, yeah, and then go till about 3:45, 4:10, and then we'll close it. I hope you're, yeah, is that fine? And then you can escape the traffic and so on. Yeah, I'll just have to keep sipping hot water a little bit more.
Coffee's also, hot coffee's also there.
Yeah. Okay, we went through this. So we said, the ratio is much higher, and it seems at least to be not as bad as China. So why hasn't growth suffered in India like in other countries that experience this crisis? You see, a big part of that, of course, is that it's with the public sector banks. Now, remember what happens in typical, if the banking system, like what happened in the United States, what happened in many parts of East Asia, is that once let's say the exchange rate collapses, once growth starts declining, people then say basically the firms are not in good shape, the banks are not in good shape, and what can often happen is that there are runs on banks. That people go and say, this is a bank that's not solvent, I want to get my money out of banks. This is what happened in Indonesia. And US as well to some extent. But because in India the banks are a public sector owned, you know that Bharat Sarkar is behind them. So it's both a good thing and a bad thing. It's a good thing in a crisis, you don't get the same panic herd behavior that you would if it were privately owned. So remember that I should step back and say, even where there is private ownership of the banks, which is what happened in the 1930s in the United States, depositors still are guaranteed their money. So in order to prevent this run where people line up and take money out of the banks, there is deposit insurance in many parts of the world. But it doesn't extend to everyone. It extends mainly sometimes only to small depositors up to a certain point and so on. But in India, you don't even need that, because in fact, the statistic, you should all go and check and ask your students. In the 2008 crisis, when the global financial crisis happened in India, you will see that the share of the public sector banks in deposits probably actually increased rather than decreased. Which just shows that because your financial system is public sector dominant. Now, it's a good thing but it's also a bad thing, because you don't get the kind of what we call, you get moral hazard, where you don't have an incentive to take the right risk-taking behavior to engage, because afterwards you don't have to pay the consequences. So it's always a trade-off in these situations, and that's what happened. The second reason in which India was different was that, you see, in most countries after crises, growth collapses. So if you look at, for example, India, after the first 91 crisis, growth declined. During the East Asian crisis, we had suffered nothing at all. But notice that, in this period, which is, let's call this the post kind of twin balance, let's say the twin balance sheet problems arose around 2009, 2010, India has still posted respectable rates of growth. 5, 6, 7, 8, between 6.5, 7. So we didn't suffer the collapse in growth that is typically associated with crises. Part of the reason, of course, was that, remember that despite all the excess that happened in terms of investment and borrowing, a lot of infrastructure got built, and so the supply capacity of the economy increased, and that to some extent cushioned against the problems that might otherwise have happened because there was a lot of investment back or some investment backing up what happened, the consequences exposed turned out to be much less than elsewhere, and that's why we haven't seen a total collapse. What we've seen more, and especially more recently, is a slowdown rather than a collapse in growth. So that's a second reason, way in which India has been different. So I've showed you this investment went up, eased long-standing supply constraints. Now the other thing is, now this comes to your question about how do public sector banks, how have the public sector banks responded? Now it's possible, and this is hypothetical, it's possible that if all these loans had been with the private sector banks may have chosen a course of action which may have been different from the public sector banks. But certainly in the case of the public sector banks, and in the case, and more broadly, I think people still had the experience of the 2002 crisis. I.e., they felt, or they could have felt, that look, give it some time, do a little bit of, so what banks did was they actually restructured a lot of loans. So basically saying, okay, we'll stretch out the loan, reduce, even if it net present value terms, we'll maintain the same loan, you can pay it over much longer periods and reduce the burden of companies. So this kind of giving time to time thing happened, partly from that experience, so that they simply said, let's give more time, growth will pick up again, and things will become better again. So that was part of the reasoning behind this, and the fact that public sector banks were involved could have been part of that as well. So how is it different? Public sector banks, growth didn't collapse because investment was built. There was this strategy of let's give it some more time. And related to that, of course, is what we call evergreening. It's kind of related to that, but not the same. Essentially that you also kind of postpone the problem. So supposing you company, you owe me money, what I do is I lend to you to repay me back the interest. That's kind of called evergreening. It can carry on for some time. Again, if you think things are going to pick up, you can kind of do this. But essentially it's a postponement of the problem, and also it's a little bit of, you have to, kind of suppress the problem, think that it'll go away. And sometimes it may also involve, accounting practices that may be, not of the highest quality, let's say. So this also happened. And essentially that what you see here is that the debt of many of the stressed companies kept going up, which partly reflected that basically they borrowed a lot to just repay the loans and appeared to be in good shape when they may not have been in very good shape.
So don't you think partially it can be explained by the fact that in India the equity levels are not good? So what happens whenever there's a setback, the proportion of the people who get hit perhaps, that is relatively lesser. And most of the people, they are still, practically speaking, below the poverty line. Having not good development levels or sometimes ensures that you will not be majorly hit by any company.
No, this has nothing to do with the poor people are not involved in this. The poor did not borrow, and the poor guys, they had nothing to do with it.
Overall economic scenario.
No. I think that, if suddenly, supposing you had sudden collapse in the exchange rate, like we had in many countries, I think there could have been huge disruptions. So I don't think we should bring in the responsible poor. The responsible poor are not responsible for the situation of these banks. I think they have behaved impeccably. In fact, the point related earlier about agriculture, repayment by, in many of these agricultural loans often tends to be higher than with some of the people here who borrowed.
But I'm not blaming the poor, sir.
Yeah, let me have the discussion. Yeah. So I'm not blaming. I'm saying it as, we have a tendency everything to bring in the poor. The poor have nothing to do with this. They have nothing to do with this. Yeah, you have a question there. Yeah, one question. Yeah.
Farm loan waiver by both Maharashtra government as well as MP. Will it affect this non-performing asset cases?
So a farm loan waiver will come to when we do agriculture. So here let's talk about industry. We're going to have a section on agriculture. We'll do that farm loan waiver there. Yeah. So this is a cartoon basically. This is what happened in 2002. In that and this is, some of this thinking underlying also what could have happened. And to be honest, I have to be honest as well, that when I first came to India to take up this job, although the first piece of analysis that we did, my team and I did, we actually raised this twin balance sheet challenge as a, identifying it as a twin balance sheet problem and so on. But to be completely honest, I did not think at that stage, while I knew this was a big challenge, I also thought perhaps if interest rates could come down and growth could pick up, maybe some of the problems would kind of become less bad. But, so in that sense, I'm also a little bit guilty of this, something magical will happen, but it's not turned out to be that way. So what have been now, so we spoke about the run up to this twin balance sheet problem. We've also said that, the consequences have been slightly different than other countries. But the question is whether, the way we've handled it in terms of giving time to time, evergreening, etc., where is it sustainable, or, do we need to address this a bit more seriously? Yeah? And so it's turning out that, the problems have been getting more serious. So this is a comparison of the return on assets of banks, what's happened to, private banks, SBI, public sector banks. And generally here an international norm is that, if a bank earns 1.5% in terms of return on assets, that's respectable. Basically, Indian banks, apart from some of the private sector banks, are so the health of the banks in the long run is not in great shape. And then of course we see more recently, so here's the thing, right? So you say we had this twin balance sheet challenge. We didn't suffer the worst consequences. We were different. But now you could make the case that the twin balance sheet challenge itself is having an impact on many of these things. So for example, you see the latest data on fixed capital formation. Actually, this is not updated again because I think the latest number is not minus 2%. Is this updated? Oh, okay, good. Okay, it's updated, right? Yeah, okay, it's updated. So you see that real growth in fixed capital formation is now in negative territory, real capital formation growth, and that is what is keeping investment down. We see that credit to industry, you see that has been declining very sharply. And now one point I should tell you is that now here's something is again an exercise for students and for all of you to think about here. That in some ways you could argue that this exaggerates the problem because, and this is again a point that a different version of the question that you raised. Now it's possible that banks may not be lending to industry, but it could be that the firms are getting money from other sources. So for example, what are the other sources? They could be raising money directly through the bond market, and that's happening to some extent. They could be getting money, they could be borrowing more ECBs, foreign borrowing. That could be happening. They could be borrowing more from abroad. And of course, they could also be borrowing from other parts of the economy, like commercial paper, etc. Insurance, pension, all those things. So one interesting thing which we've done already, actually, which we've done, not showing it to you, that if you look at overall financing to industry, it looks a little bit better, but it's also not, but it's also the general direction is the same. The other interesting point here, again as a pedagogical device, is relates to a question that you raised. You should, if you do this with and without Uday, it's very different because Uday contaminates this to some extent because Uday is also part of this. So borrowing by the discoms is also part of this, and that changes the picture again to some extent. So again as a pedagogical device, industry credit, the bank borrowing is declining, but is it declining from all sources put together? And that's a useful thing to do. But in this case, we find that in fact the numbers, at least the broad trend is very similar. Now, also, if you look at MSMEs, of course, they are also facing the squeeze to a great extent. But again, with the MSMEs, one thing is that they could be borrowing more from NBFCs or from other schemes. So it's something that is worth checking whether they are doing as badly or not. And finally, of course, how does the twin balance sheet itself affect all this? We showed you yesterday that the transmission mechanism has been impeded because if the bank's situation is not very good, they don't generally pass on cuts in rates because they want to maintain healthy profit margins to make their balance sheets look better. And so the twin balance sheet challenge itself affects investment and credit and growth, and this is an example of that. So here's a kind of interesting, so what I love as pedagogical devices is compare and contrast. What is different, what's similar, and why is that the case? So Japan, see, in one sense, this Indian thing is similar to Japan, is the following. High NPAs, it's taking a lot of time, like in Japan. And in Japan, maybe, do we have the chart, Ranida, after this? Okay. If you see what happened, Japan, the crisis happened in the early 90s. Japan is growing very rapidly, and for a very long time, for about 20 years almost, Japan's growth rate has been 1.5%. So it's not been a crisis, but very slow growth for a very long period of time. Now, the Indian case is similar but different. It's similar in that it has also slowed down. It's not collapsed, but the levels of that growth are very high in India compared to Japan, and that's the similarity with Japan. But what is different is that we have robust growth, and in all these countries, in the US and in Japan afterwards, basically they had deflation, and because they had deflation, using monetary policy to revive the economy became very difficult, and in that sense, India has been a little bit different. So you're almost, in these cases, you're almost blessed with higher inflation than other countries that have deflation because they cannot respond to this by using monetary policy. The other difference is that India and Japan are similar in that, and China, in that the borrowing happened by private firms. In the case of the United States, the borrowing happened by households mostly to borrow and buy properties. But of course, the difference between the United States, Japan and India have taken a lot of time to resolve this. The US did it very, very quickly. Now, I cannot ignore the China question. What is China doing? Now, in China, what is happening is very interesting. China has had very, very rapid growth, and the growth has started to decline, right? Now it's about 6.5%, from about a peak of 11, 12 is down to 6.5%. Now, in the case of China, a lot of the borrowing, it's not just that the lending is public sector banks, but a lot of the borrowing is by state-owned enterprises. That's one difference with India. And many of these state-owned enterprises are steel, et cetera, right? So China faces the following dilemma. Politically, it seems it's very difficult for China and the political leadership to accept growth rates below a certain amount. So at one point, they said the politically acceptable growth rate was 7.5, now it's come down to 7, now 6, 6.5, we don't know. So in order to prop up growth, they have consistently used stimulus policies to prop up the growth. And the more stimulus you do, the credit only expands. So China is caught in this classic dilemma of, to address the problem, you have to shrink this credit. You have to, lots of, for example, in steel, there's a lot of overcapacity, huge amounts, right? It has to cut that. It's beginning to do that. But cutting capacity in steel means laying off lots of workers. So it's true of India, it's true of China. In order to address these things, there has to be social disruption because, basically unsustainable things were done. You have to correct that. So China is caught in this dilemma. To address it, you need to take some tough political decisions like India does. So the easier thing to do is to stimulate, keep up pumping and stimulating the economy, but that only increases the magnitude of the problem and postpones the problem. But in some ways, China has also started taking action. It's trying to revive what it did, for example, in the early 2000s. It is, in the steel sector, it is trying to reduce capacity. They made a public thing. And there are moves afoot to try and see how these banks can be cleaned up. But in a sense, they're stuck in a very similar situation to that of India. But one difference is that they have much higher levels of credit and non-performing assets, and most of the big doubtful borrowers are state-owned enterprises, whereas in India, it's private sector enterprises. Now, I'm going to tell you, is that good or bad? I'm going to come to in just a second. Huh? Okay, so what has, it's not as if the RBI and the government have taken, sorry, you have a question, yeah.
If you look at the NASSCOM reports, they mentioned that at least 100 MNCs have been setting shop in India, per year, at least 100 over the past 10 years. So how do you think that the competition with these MNCs of the local firms, in terms of competing for resources, could have contributed to the corporate stress?
I don't think there's, certainly in the IT sector, the IT sector is not a big part of this problem, right? Just to give you a sense of the...
This is across all sectors,
yeah.
the MNCs that they have counted.
Yeah, but I think, infrastructure, there are no MNCs in India doing infrastructure at all. So the big problem sectors or challenge sectors in India are power, steel, clothing and textiles, and then the rest of it is dispersed. But these are the big. Now, the question is, I'll come to the interesting question about the telecom sector. That's very interesting as well. There, you have something like what you just said, i.e., if you get more competition. In the case of telecom, we've had a new entrant into the market, and that actually, because of various factors, could affect the profitability of the other players. So in that sense, in that sector, the kind of point you were making could be applicable, although it doesn't apply to the other sectors. In steel and infrastructure, it's no competition from MNCs. So the government has done a series of things, and the RBI, beginning in June 2014, the previous governor, took a series of actions. I don't want to go into all the details. It's all very, very technical and so on. But essentially, one thing I would point out, the AQR, the asset quality. Keep that in mind. I'm going to say something on that. And of course, most recently, the government passed an ordinance which has given the RBI more power to address this twin balance sheet problem. And today's newspaper, the headline you may have seen in Business Standard. I don't know whether you looked at the top half of the paper or the bottom half. I think the bottom half was much better because it spoke about all of you, the IIT Delhi course that I'm doing. But more important, the top half has the finance minister talking about what's happening on this. So I would much rather you read the second half of the paper, but the first half has this as well. We will see what's going to happen in that. Now I want to come to what is difficult. Why has it taken so long, and what is the heart of the problem here? And it relates to the distinction also I made between who's borrowing in China and who's borrowing in India. I think that at the heart of it, it is, core problems, it's not just about the banks, it's about companies, it's a twin balance sheet problem. It's an economic problem, not a morality play. Essentially that, think of it this way. when we read the newspapers, we tend to think that a lot of it was because of cronyism and corruption, and all the headline cases are like that. But I think it's fair to say that we don't know what the proportions are. We also know that some portion of the problem was also because, many people made bad investment decisions. They were not bad in an ethical or moral sense, it's not could have been, but you just thought, oh, growth is happening, it'll continue. So bad investment decisions need to be kept apart from, unethical business decisions. And I think part of the challenge in a political system like ours is how do you, A, separate out the two, because the two of them have very different responses. If it's because of cronyism and because promoters never put in any equity, then of course it's one solution. But if it's just honest mistakes, you should have another solution. As someone said quite rightly, this stressed debt is heavily concentrated in large companies. And so that's both easy in one sense. It's easy in one sense because, you can actually say it's not about millions and millions of loans, it's maybe about 100 loans, and you can do that. But if it's with private companies, and a few private companies, that creates a huge set of political challenges as well. Now, what is that challenge? Many of these companies are unviable at current levels of debt, requiring debt write-downs. So the heart of the problem is a political problem. So I'm going to show, I may not show you this, maybe I might show you the chart. So for example, if you take the power sector, because energy prices have come crashing down, and we'll do that, a lot of the capacity that was built is simply unviable at current market prices. So you have to have a lot of, even in the steel sector, you may have to have a lot of write-downs in order to salvage some of these assets. So essentially, it may require writing down debt. And that comes to the heart of the political problem. How do you, as a political system, be seen to be writing down debt which favors some private companies? Now, that's the heart of the problem. It's not, no political system finds it easy to do that. And that's why it's interesting, the contrast with China. If you also own the guy who's borrowed, maybe it may be easier, because it's all in the public sector. But here, you have to be seen to be writing down debts to the private sector. So, so anytime that happens, people will legitimately ask, how do we know this is yet another instance of favoritism and cronyism and corruption? And there's just no way. I think even sophisticated political systems find it very difficult to make this distinction. And in India, it's very, very difficult. It's very difficult for a number of reasons. We have the whole CBI, CVC. So any bank managers are very, very reluctant to do this. And so in that sense, banks have been finding it very difficult to resolve these cases despite, and that's what's been happening. So what the government is now trying to do, and what the RBI is trying to do, is to see whether we can find a mechanism whereby there's some way of getting debts to be written down, maybe penalizing the promoter if necessary, and then making these companies, so that essentially you're trying to salvage the assets that are there. Some assets probably cannot be salvaged, some will have to be written off, and some can be salvaged. Then the question is, when you salvage it, will the existing promoter run the company, or should we get a new promoter to run the company? That's another question that will have to be addressed. But I just want you to keep one thing in mind. See, people say, for example, to solve this problem, okay, let me come to that in a second. So, and delay is costly, so we have to do it quickly. We know this. And in the economic survey, we came up with our, the finance minister mentioned it that day. He said, I argue with Arvind every day about UBI and about bad banks. And, so this is, this is a proposal we made in the economic survey. But I think that, I think that that's something that we need to address. So just to step back, and if you read this year's survey, you'll see this. if you step back from all of this, essentially there are 4, I think, R's that are required to make progress on this. Recognition that essentially let's come clear on what is the magnitude of the problem. I asked you to hold the thought about December 15 AQR. Raghuram Rajan in December 15 said we need to have an asset quality review that is forcing all the banks to come clean about how much non-performing assets they really have. And if you see since then, the total, because assets can be non-performing or stressed, yeah? The total of the two may not necessarily have come down, but certainly a lot more of what they called stressed have now been recognized as non-performing assets. And so in that sense, I think we've made a lot of progress on recognition. I think we have a better sense, but it's possible that we still don't know the true amount of the stressed assets. Some private sector companies think, like Credit Suisse, that in the public sector banks, the stressed assets could be as high as 20%. That's their estimate. But we have to constantly monitor this to see whether we've actually come to grips with the scale of the problem. But I think we made a lot of progress on recognition. The second and third are where we are today: resolution and recapitalization. Now, here's the thought that I wanted to introduce now. People think that, oh my God, the government has to put in a lot of money into the banks in order to recapitalize them, to bring them up to levels that is considered safe and prudent. Now, but if you think about this, if underlying assets are bad, if, let's say you have 100 rupees worth of assets, supposing bad decisions were made and those 100 rupees are only worth 50 today, supposing, just an example. The point is that the remaining 50 of loss is already there in the system. It's already there. And because public sector banks mostly have this 50 rupees, it's already there in the public sector banks. It's already there for the government in some form or the other. Maybe the banks can raise some capital and so on, but mota, as they say, that is a thing. So the notion that we have to, fresh money will be needed to do this is a bit of an exaggeration, because that money already has to be made. The government already, it's what we call, remember when you did the fiscal policy, contingent liability. This is what is a contingent liability, that government has some explicit debt, but if it owns some assets and those assets go bad, the government is it's a contingent liability. So all that's happening is a contingent liability becomes a real liability. That's all. So now, here is where I think, again, the China-India example is, I think, important to keep in mind for perspective. Okay, so let us say, for example, that there are hypothetical example. Please, I'm not responsible for any numbers, for the accuracy of any numbers I'm going to quote. I don't believe them, I don't know them, I'm making them up as we go along. But supposing we said that if you look at the numbers, let's say 10 lakh crores are stressed assets. Let's say 50% is bad. 5 lakh crores. Remember, 5 lakh crores is at today's GDP 3% of GDP. Am I right? It's 1.67. It's about 3% of GDP. So in the worst case scenario, the government will have to, just own up to contingent liabilities of 3% of GDP, and kind of life can really go on. I'm not saying it's a good solution, because we have to think about how this will happen again, how we should restructure the banking system and so on. But mota magnitudes, that is very different for China. China, because the scale of the problem relative to GDP is much bigger, you would think that if everything is comparable, ceteris paribus, as a share of GDP, the amount they may have to put in by the government will be much larger. So I believe this is a big challenge for India. I do think that we have to address it, but I don't think we're in a situation where this is going to make the economy collapse or whatever, because the magnitudes are not as big as in many. Iceland, I said 11 times, that means 1200% of GDP, correct? Something like that. So, but having said that, I think this resolution is the trickiest. I said all of this to make one point. Money is not the big problem here. The problem is the political problem of how do you, a political system is seen to be forgiving debts to the private sector. That's the heart of the problem. Final point, the final reform, of course, is that, I mean, it raises some bigger issues about our banking system in many ways. You know, one, should banks be doing infrastructure lending like they did in the past, or should we have other financing mechanisms like in many other countries? Bond markets provide long-term finance compared to banks. Should that be a solution? Second, do we need a different structure of the banking industry? For example, do we need to consolidate? How? Do we need more private sector participants? How? So all these are questions that I think come up when we think about the broader addressing the challenge of the banking system. So we made progress on the first R. R3, I think, is less of an issue. I think R2 is the heart of the current issue, but R4 will be the heart of anything if we want to resolve this on a more sustainable basis, going forward. And so this is one way of thinking. But coming back now to teaching this, because I have one more section I want to do. I'll take some questions before I get to that. So I would say that in terms of teaching these things, posing the question, first, comparisons. On the crisis, there's a whole wealth of foreign crises which I think students should know about when we think about India and the Indian situation. The whole contrast and comparison. And here, one of the contrast and comparison is that, in the run-up, it was very similar to other countries, but why is it very different in the aftermath of these things? So I think there are various ways of organizing the material to make it come alive to students. I would urge you also as teachers, to think about, always try and, if you make it analytical, conceptual, international comparisons, I think the material comes alive much more easily than it would otherwise. So any questions on this? Because I have one last section, very, a gossipy kind of section before we conclude today. The gentleman at the back there.
Sir, what about the problem of moral hazard?
Yeah, I think that, you see, I think that there are, so the question is, what about the problem of moral hazard? Does everyone know what moral hazard is? I know that there are some people who don't know moral hazard, because I didn't know moral hazard for a long period of time. Who doesn't know what moral hazard is? Please feel free to raise your hands. Exactly, yeah, please, exactly. So moral hazard is simply that when you have a set of incentives put in place which make you behave in a way, so just the best example is that if you have insurance, you become more dangerous in your behavior. So if you have health insurance, you may smoke a little bit more than you otherwise. If you have fire insurance, you'll be less careful about doing the safety things. So that's what's called moral hazard, right? So here the moral hazard operates at many, many levels, right? So for example, one level is, supposing you recapitalize the banks today, right? Then there's the moral hazard is, they made a lot of bad decisions. How do you penalize them for that? What lessons will they take away? Second moral hazard, if you forgive the debts to the private sector, they will behave badly, right? Because And then there's, don't get me into trouble, farm loan sector.
It says it was a deliberate, they did not repay.
Yeah. So I don't have a strong view on that. I cannot have a strong view on that. But, but that's one issue. So now, but one answer to that is no system can eliminate moral hazard. Moral hazard will always be there in systems. The only thing we can do is to try and draw the boundaries better between, because, for example, you have to have deposit insurance in systems which are private sector banks. We've decided that because if you don't have deposit insurance, in a crisis, the run on a bank can be so severe, it can bring down the whole banking system and led to what happened in the 1930s. So you have to have deposit insurance. You face the consequence. All you can do is to try and regulate that better, have better monitoring. Similarly, just government ownership is itself a moral hazard, right? So what do you do with that? But then if you then say, well, if you could, suppose you said I could privatize the banks, then you would have to have regulation to offset whatever you may do. And then we know, for example, in the United States, that regulation didn't work. It didn't work, and then so they had to do all kinds of things. So no system is perfect. Moral hazard can never be eliminated. All you can do is you can be vigilant, and this is like, ongoing, the authorities have to be vigilant. They have to have proper regulatory systems, and both to avoid crises and in the aftermath of crises.
And what Raghuram said, AQR.
It will go 5 hours. Regulation in between.
Regulation, okay. Yeah, exactly. If you come to that kind, we have to have good regulation as well. Absolutely.
Raghuram said AQR is very important.
So that's the recognition part. Yeah. Please. In the question, please. Yeah.
Sir, one small clarification. So when you're comparing regarding this non-performing asset both in India as well as China, so as per your view, which one is more volatile and severe? Is it in India or as well as in China? In your view? Because in India it's more in the private sector as you.
And as I said, firstly, magnitudes are different. So that changes. Second, one is public sector, one is private sector. But then you have a third contrast. In India, it's much more concentrated now, maybe than it is in China. So all these are, just different things which have to be dealt with differently. Well, certainly the fact that magnitudes are bigger in China does mean that it is a bigger problem in China to that extent.
Yeah, continuing to China problem, that is, in our case, you said that it's around 3% of GDP that one-off fiscal deficit rise and you can address the problem. In case of China, it could be around 8 to 10% of the GDP, but their public debt as a share of GDP is pretty lower compared to us, around 20-25%.
Yeah, actually, see, the thing is that, so that 20% number is no longer the right number, because they have, if you look at the consolidated debt, government and local government bodies, it's much higher.
Okay, so still,
both could be finally both could be manageable in that sense, yeah.
Yeah, but still they will need to have around 8 to 10% of GDP, let's say, as a fiscal deficit at one or spread over. So it will probably disrupt the bond market across world, or they will use their foreign exchange reserve.
Yeah, see, China doesn't borrow. See, that's the advantage of having a closed capital account. They don't borrow, and therefore they could probably raise the money financing domestically. So in that sense, there'll be less disruption.
Saving rates are
pretty high. Exactly. Yeah. Exactly.
Can I?
Yeah. Please. Yeah.
Okay. So can we have two straightforward takeaways from the genesis of this problem?
Yeah.
One, if the public sector banks should have diversified their risk portfolio, the extent of the problem should not have been that serious. Two, if the PPP implementation mechanism would have been better, the seriousness of the problem should not have been that much.
Two takeaways. Public sector banks should have diversified. PPP projects should have worked better. So, you see, it's easy for us to, I would say my takeaways would be a little bit different. Yeah, my takeaways would be that One, not that banks, public sector banks should have necessarily diversified, but the financing of infrastructure itself should have been diversified. Public, private, bond markets, much more diversification, I think that would have helped. PPP, I think, is a very, very complicated issue. And I'll tell you why. Just because, I'll give you, when I talk about how the political system finds it very difficult to deal with writing down loans to the private sector, the same thing happens with PPP contracts. Because remember, PPP contracts, often things change and they have to be renegotiated. They have to be. It's in the nature of things that if you have long contracts, things change, you have to renegotiate them. But the same problem that afflicts the writing down of loans also is going to afflict the renegotiation of PPP contracts, because you will always be open to the criticism that you gave someone a sweetheart deal on this. Say some long-term power contract.
We can have a legislation on that, right?
No, but it's all about how you implement it and how people believe it's being implemented. And that, I think, is an almost intractable problem in India today. That's why you see no PPP activity going forward, because we still don't know how we're going to renegotiate, how we're going to have efficient recontracting in all these contracts going forward. It's, I think, a very difficult question and a mirror of this whole public-private thing. So, no, there was a lady there with a question here. Yeah, please. Yeah.
I just wanted to find out, because you mentioned in the economic survey it was written that 7 lakhs crores of rupees. 10 business houses had incurred debt of 7 lakhs crores of rupees. So you mean to say that all these rupees, there is no problem for dealing with closing down such the entire loan? That is one question.
No. So as I said, I think the fact of that could make it more difficult, because if there are these big business houses and you have to write down their debt, it might make it more difficult politically rather than less difficult.
No, you mean to say that there is no problem to just to write off the entire amount?
I'm saying that there is a problem.
Why are we calling this Vijay Mallya, making it as a big issue for calling back Vijay Mallya?
No, I said it is a problem writing down these loans to these companies. It's not a problem. It is a problem.
And secondly, I just wanted to find out this NPAs. You were mentioning about NPAs were improved because of the economy was doing well.
That was in 2002. Yeah.
But then at the first place, what was the reason for that NPAs? It was almost 23%.
Yeah, because see, that partly was the question that was asked here. In the late 90s, growth started to slow down, and a similar thing happened, that as growth started slowing down, the profitability of the companies came down, and they were not able to repay the banks as well, and that happened. So there was one more point I wanted that I should say, just so that all of you know clearly. What happened? There was another reason why we were able to solve that 2002 problem easier than today. At that point, interest rates were very high, 13, 14, 15%. And banks had a lot of government securities. Because SLR was much higher then, banks had a lot. When from 13%, interest rates came down, I think, quite a bit. As they started coming down, the bond holdings that they had, their value went up, and they could book these as profits, and so the profitability of the banks improved as a result of that as well. So in the run-up, it was slow growth, but then we were able to solve it better, because then growth revived again, and banks had a lot of these it's basically investments that were not credit-related investments. Their value went up, and their profitability increased, and that brought down the NPAs as well.
So can I?
Okay, then after this, I'm going to.
Yeah, since we have been doing the crisis, and it's I think not very proper to just discuss the twin balance sheet problem for the current contemporary crisis or impending crisis in the case of India, what I wanted to say that in a financialized market economy, is it possible to completely avoid cyclical crisis of this kind? Because at least history has shown that these crises are not just periodic, they are frequent and they are cyclical in nature. That is number one. And number two, that I would like to ask in continuation of what has been asked, is that the moment we say that writing off bad debts becomes a solution to move on a growth path, forget the moral hazard question. What are the lessons that we would be giving in terms of an economy that is a growth-oriented economy?
Remember, we said in advance that you would have assessments. You have asked the perfect question for an assessment, I think. This is the question I would pose to all of you in the assessment. What is the right way forward, moral hazard or not? What should we do? And I think it's a question that I would like you to think about. I would like your students to think about. I think it's a very good question. So,
do we have a case, the international side, where something like this writing off has been done at a large scale? So we can learn from that?
Yeah. In many, in the US, in Sweden after the housing crisis, in East Asia, it necessarily involves huge amount of write-downs as well. Otherwise, you're just saddled with these things and they don't go away. Now, I want to make it come alive. What are the successful and unsuccessful central banking experiences? I'm going to tell you who gets an A+ for the best central banker ever. Okay, so we've studied monetary policy, we've studied financial crises, right? Central banks are meant to manage both of these. So I've drawn the first two columns, how successful have they been in the run-up, i.e. either in preventing high inflation or in preventing a crisis, and how successful they've been in the cleanup. So the way I like to put it is that, are there cock-ups in the run-ups or in the cleanups? Where do we make mistakes and that? So one huge success, of course, was Alan Greenspan. In the late 1990s, the US economy was really picking up steam, Most central bankers would have raised interest rates there. And but he said, look, there is something very special about this going on. It's actually a huge productivity increase, not demand increase, and he didn't raise interest rates, and he turned out he was right. So that is a great example of in the run-up. In this case, he avoided a massive squeeze by not raising interest rates. But then the same Alan Greenspan, of course, less successful, as many of you have said, in the run-up to the housing bubble. Maybe lots of people think he should have acted more vigilantly, paid more attention to this. No, there's again a big mistake. So in terms of the cleanup, that first column should say success, not less success. A+ in my thing for the greatest central banker ever was Paul Volcker. He was brought in when inflation was high in 1980 or 1981. He raised, at that time, of course, in advanced economies, interest rates were upwards of 15%. He came in and he brutally tightened the economy by raising interest rates and brought down inflation in a very short span of time. Now, that is a decision that was so unpopular, inflicted so much cost, that it required someone of enormous courage to do that. I think, see, it's easy, this Greenspan mistake or success of not raising interest rates is actually relatively easy, but to actually squeeze the economy hard, and unemployment for a year was very, very high. It was related to the actions that the Fed took. Of course, what happened, of course, was that luckily, because it was credible, because it was swift, The economy did go into a recession, but afterwards I think it recovered very quickly, and then it was followed by a long boom. So I think that action was extremely successful. I think the same thing Mario Draghi, in 2012, European economy was in a funk. All these things were not working, and of course he said, I will do whatever it takes, and then the European economy has picked up. In fact, in 2009, the European central banker did exactly the opposite of what Alan Greenspan. He tightened, thinking that inflation was the bigger problem, when in fact it was growth that was the problem, and in 2009 he tightened, so that was a case of a less successful response. Japan, the failure to clean up the banking system, I think, led to nearly 2 decades of lost growth. So there too successive, this of course, all banking problems are a combination of both what central banks do and what governments do. And I think, so in the Indian case, I think the high inflation episode was an instance where we had, I think maybe 5, 6, 7 years of double-digit inflation was, I think, a problem. Of course, again, in this case, it was not just the RBI that was meant to deal with it, also, government, fiscal deficits, commodity prices. But of course, a Volcker would have said, I don't care, I will just squeeze the economy. Whether it could have been done in India or not is, of course, a very open question. I think that we had success in both Governor Subbarao and Raghuram Rajan had great success, I think, in the 2013 episode. I think that a combination of what Governor Subbarao suggested, which is to increase interest rates on FCNR loans, and then that was proposed by him, and then Raghu took over. I think a combination of his communication, his stature, plus these actions ensured that the 2013 crisis actually was maybe worse could have happened, and that was prevented. But in my book, central banks should be judged or assessed both in terms of prevention and in terms of what they do afterwards. They should be judged both in terms of, in both cases, whether they achieve stable inflation and whether they avoid financial crises or not. And I think that the experience around the world is very rich, offering all kinds of lessons for all of us to take away. But in some ways, the most difficult decisions are the ones where you have to inflict costs on the economy to achieve something. So there are no free lunches in this business. I think that's why these are all tough decisions. But the point is that one learns a lot, and I think students too should learn a lot by reading. So for example, I think that in terms of reading material, I think it would be great to actually read the stories written about these central bankers as well. I think Governor Subbarao's book is probably, well worth reading. There's a book on Alan Greenspan, which is well worth reading. So, how these decisions are made, why these decisions are made, what is the underlying economic analysis, the underlying political analysis. This is what I think is, so today we've done macro stabilization in the morning, financial crisis in the afternoon, and I promise, so we've gone 2 hours non-stop, and I think we will stop there and look forward to tomorrow, where we're going to discuss in the first half subsidies and universal basic income, and in the second half we're going to talk about all the richness of the Indian states. What are the different patterns of development in the different states. So look forward to seeing you all tomorrow, and the material will be made available today. And thank you very much. Any last questions?
The handout you have given, written about why we ready a census.
Yeah.
And twin balance sheet thing.
Yeah. So yeah, we will post the.
You can also include C. Rangarajan for East Asian financial crisis.
Yeah. This is illustrative. It's not exhaustive.
So twin balance, we are concerned for the banks as well as the corporate. But in this process, our infrastructure sector has suffered a lot. And even before we recognized this problem, the corporate was already complaining that government has left this development of the infrastructure to PPP and all.
So now what are you thinking for the infrastructure sector?
Infrastructure module. We go to last question. Yeah, someone who you haven't asked a question, so why don't you get a turn? Yeah, you haven't asked a question. Yeah. So those who haven't, please.
Yeah, I would like to ask you, how could informal credit markets come in way of effectiveness of monetary policy?
How could informal credit markets? I don't know whether they come in the way of monetary policy. I think that, the point is, by definition, an informal sector, has, firstly, the question was asked yesterday as well, that there will be links between the informal and the formal sector. For example, if informal sector interest rates become, if formal sector interest rates become cheaper, there will be substitution from one to the other, and vice versa. So I think that more, the logic of the informal sector, has a lot to do with collateral, lack of trust, lack of institutions, and I think that's why, by definition, the transmission mechanism monetary policy, that kind of fits in less easily with that. And I think that's where I think it's more the financial inclusion agenda that becomes very, very important to solve that kind of problem. Yeah.
May I allow to, one question related to the previous question?
Yeah, please.
It is related to, does India require another currency?
Another currency?
Yeah.
Why?
Like China.
What do you mean by another currency?
I am actually I am very confused about.
Oh, you're talking about.
China had a system
of dual currency for some time.
Many issues related to currencies. So, does India require another currency?
No, China does not have two currencies. China has only one currency. It doesn't have two currencies. At various points in time, they may have had two exchange rates. And even we had two exchange rates at some point in time. But I can think of very few countries which had two currencies. By definition, it's called, fiat or monopoly money. It's only one currency. I mean, there can be private currencies like Bitcoin and things, but that's different. That's not what the government does. But currency only one. I thought you were going to ask, which we can come to later, is, just as China is trying to make its currency an international reserve currency, should India also try that or not? And that's a different question. But since that's a question you did not ask, I will not answer it.
Excuse me, sir.
Okay, how many? My team. How many questions should I take? Last question. Who gets? No, I want someone who hasn't. No, I want someone who hasn't asked a question to ask a question. No, you've asked a question. I know you've asked a question. You've asked many questions, sir. You've asked. Even my friend has been quiet today. Someone who's not asked a question. My friend, all my Tamilian friends are no questions. My Malayali friends, no questions.
Yeah, with you, sir. So you're all your friends now.
And that's true. No, all of you are friends, but I want someone who hasn't asked a question to ask a question.
Eagerly listening your lecture.
Yeah.
Okay. Not listening by default.
Anyone? Sorry.
Answer the question which you raised.
No. See, I'll tell you what. That's a reserve. So an easy answer to that question is you should read my book Eclipse, where I talk a lot about reserve currencies and things. But I mean, the only interesting thing I will say is that we can say many things about this, but in some ways, China is trying to build a reserve currency, and in 2016 or late 2015, the IMF made it a part of its basket. But China had to, in order to have a reserve currency, you have to allow foreigners access to your capital markets. Because, if you say, I want it to be a reserve currency, I should let all of you own my currency, foreigners. But what has happened, ironically, is that since 2016, when there's been pressure on the Chinese currency and capital has been leaving, China has in fact had to reverse some of the measures it took, which were necessary to kind of make it a reserve currency. So in some senses, China has had to go backwards because of all the pressure it's come under. But a question of whether a country should have a reserve currency or not is I think, it's a political question. It's got a lot of economic preconditions. It's too long and complicated, and I'm really sorry that I raised the question myself. Okay, thank you very much. See you tomorrow.
Thank you so much.